last week, towards the end, we started to discuss foreign exchange risks. So I explain you there are three types of foreign exchange risk: transaction risk, or transaction exposure, translation exposure, economic exposure. Foreign exchange risk can arise due to one of these exposures, and in this course we are not going to pay attention on the economic exposure, because to mitigate that economic exposure, basically what you have to do, it's depend on your business strategy and your strategic decision in your business. But in a treasury, you will mostly focus on transaction exposures and translation exposure. So therefore, we are going to discuss on these two. But before we move forward, can someone brief me or others what is a transaction exposure, what's a translation exposure, and what's an economic exposure? Can someone explain what is the transaction exposure?
Transaction exposure happens when one enters into a transaction with counterparty. The risk arises due to the exchange rate movements in the certain currency.
I didn't get that properly. If you can repeat it, please.
Transaction exposure happens when so one party enters into an agreement with another party uh, to buy or sell a certain currency. The exposure happens due to exchange rate movements in the market. So we are exposed to that risk. The
So
two parties.
one question. You mentioned when you agreed, or two parties agreed to buy or sell one currency against another, then you exposed to the transaction exposure. Is it correct? Does it what you say? That's how I got it. Is it correct?
Yes, due to exchange rate movements in the market, those two parties are exposed to exchange
No,
transaction exposure.
yeah. My question is, when two parties enters into a transaction to buy or sell two currencies.
Yes,
Huh?
yes, they agreed to buy or sell in the future date. So
Two currencies. That's what you
one against another.
one against another. That's true. Yes. Uh-huh. That will give you a transaction exposure. That's what you
Yes.
say. Okay. Good. Any other answers? Any agreements or disagreements with that answer?
So this also include the borrowing and lending also. The borrowing and the lending party also exposed other than the transaction.
That can happen. Is it correct?
The, the level of uncertainty businesses involved in international trade.
Level of uncertainty.
Businesses involved in the international trade.
International trade. Yes. Whenever you say level of uncertainty involved in international trade, it can be anything. It can be demand and supply for whatever the goods or services that you want to trade. So many things. But here we focus only the foreign exchange risk. So in that context, what would be the transaction exposure?
So the risk rising from the depreciation or appreciation of the exchange rate, that is derived from the transaction itself, sir, actually.
Derived from
That means
transaction
if we
itself.
are, yeah,
Yes, go ahead.
if we are having any outstanding or any future settlements, that amount may differ due to the appreciation or depreciation of the currency, foreign exchange rates.
Yes, I think that's more proper answer than the others, because whenever we enter into a foreign exchange transaction, say you enter into a transaction to buy dollars, against LKR, there should be a agreed rate. Whenever you enter into this agreement, this rate is fixed. So therefore, now you don't face any transaction exposure. You know what is the amount of rupees that you have to pay. That is fixed. So there's no transaction exposure in that case. Whenever you enter into a foreign currency agreement, foreign exchange transaction, then there's no transaction exposure, because you know exactly what is your cost or the income or your cash flow or cash outflow. It is not the transaction exposure. But as I explained, considering that with an example, this may be some sort of sometimes good or service. Price in foreign currency. Then you will receive some, or you have to pay some amount of foreign currency. By the time you pay or by the time you receive, you don't know how much you would get in terms of local currency or how much you have to pay in terms of local currency. That gives you a risk of foreign exchange. That is we call transaction exposure. You have an asset, or you have an obligation, or that means even you have a receipt, or you have a payment in foreign currency. You don't know what would be the exchange rate that applies whenever you try to purchase that foreign currency amount, or whenever you try to sell that foreign currency amount, or basically convert into local currency. That gives you a transaction exposure. Because of a transaction that you have in foreign currency, what is the exchange rate risk you have? So as someone mentioned, this can be a borrowing or a lend in as well. If you borrow in dollars or you lend in dollars, whenever you borrow in dollars, what you have to convert it into rupees to make your or to use it in Sri Lanka. Then by the time you receive this borrowed amount, you don't know what would be the exchange rate. What is the amount of rupees that you are going to get? So therefore that will expose you to this transaction exposure. The same thing is in lending. You agree to lend in dollars, but you have to buy it from the market and dollars and lend it. Then you don't know what would be that cost. So that is transaction exposure. But whenever you buy foreign currency or whenever you sell foreign currency, then you know the rate. Then it's fixed. Then there's no transaction exposure. In that case, what is the risk that you are, or what is the exposure you have? You have already entered into a foreign currency transaction to buy dollars at 205. Then what is the risk that you face? Then it will be sort of translation risk, because now $1 equals 205. This is the agreement, but next day it may be $1 may be 204. Then you have a loss in your books when you translate that amount into rupees. So therefore, this is already in your books because you have already entered into the agreement. You have that asset. Then what you do, you translate that asset into rupees for reporting purposes. Then you realize or face the translation risk. Is it clear? Is it clear?
Yes.
So remember the word transaction, it doesn't mean for a foreign exchange transaction. It can be a transaction which gives or you entered into in foreign currencies, denominated in foreign currencies. It may be a buy and sell of goods or services or something like that, or maybe a borrowing or lending in foreign currency. But once you borrow it, or once you lend it in foreign currency, you get the cash flow or you pay the cash flow, then still you have an asset or a liability in your balance sheet. In foreign currencies. But daily with the exchange rate, that asset value of the asset or liability would change. That will count as a translation exposure. The money that you borrowed or that money that you lend in foreign currencies, to make that obligation on that point initially or convert it into your currency, especially if it is a borrowing, you want to sell that foreign currency and convert it into local currency to make use of it. So at that point, you exposed to a exchange rate risk. That is a transaction risk. You are expecting some foreign currency amount. You don't know what, by the time that you receive that foreign currency, what would be the rupee amount that you are going to get. In a lending activity, you have agreed to lend some foreign currency amount, but you don't know by the time that you are going to lend it, give it to the borrower, you need to buy that foreign currency from the market, what would be the applicable rate? So that is the transaction exposure. But once you settle it, that risk is gone. That is no longer there. But still in your books, there will be an asset or a liability in foreign currencies. With the exchange rate changes, the value of that asset or the liability in local currency terms will change continuously. That is the translation risk or the translation exposure. So what is economic exposure? Can someone explain what is economic exposure? This is generally any of us may face, even though we don't have any direct foreign currency or any direct transactions with foreign parties or any exposure to foreign currencies. Even though we don't have, we face this economic exposure indirectly, because when the exchange rate changes, our maybe cost of living or maybe there will be an impact on our businesses and things like that. So that is economic exposure. The example, as I mentioned, even though a firm does not any import or export element, but there can be competitors, importers especially, they face the risk of exchange rate risk, because when the exchange rate changes, maybe price of imported goods may go down. Then the import has an advantage. So then the local firm's market share will get eroded, or that can be other way around. Price of imported goods increase, local goods are cheap, so the local firm company may get a higher market share. So all those things can happen. That is the economic exposure. Any question? These few slides, I have explained what are those exposures. Any questions?
Sir, excuse me, sir. In case of translation risk, still even though we settle the borrowing or lending, they have settled. Still, we have to, it happens as a translation risk, because we have to report that transaction at the rate that is prevailed at that date.
No, then it's not a transaction. Then it's
No,
an asset
translation.
or a liability. If you borrow, whenever you borrow, you get foreign currency. Then you face the transaction exposure, because you have to convert that borrowed amount in foreign currency to local currency. At what rate you are going to convert it into local currency? That is the transaction exposure. But after that, still you have a liability towards your lender in foreign currencies. In your books, you have to report it in local currencies. So, but the foreign currency amount is fixed. Local currency amount would vary with the exchange rate risk. That is the translation exposure until maturity. On the maturity date, again you face the transaction risk, because you need to buy that foreign currency amount from the market to repay the loan.
So, sir, that even after the settling that obligation, we have to report that in the financial year, next financial. So,
Yeah, that's what I mentioned. Once you borrow it, it will become a liability. Then you have to report it or record it in your balance sheet. The foreign currency amount is fixed, but the rupee amount or the local currency amount would change depending on the exchange rate risk. That is the translation exposure.
no, even after this, we settle that loan.
What do you mean by settle?
Settle mean, let's say we settle in.
Repay.
Yeah.
Once you repay, then there's nothing on your balance sheet.
So if we have to report that, we have to report that in our income statement or as a income.
No, once you pay the your liability, why do you have to report it?
No, as a if we have gained anything from translating that
No,
exchange rate impact.
by the time you settle it, everything would be accounted for. Say, so whatever the interest cost that you pay, it will go to your income or as expenses and will be reflected in P&L. And on the maturity date, whatever the principal that you pay, that will set off against your liability. And what is the liability amount that you recorded in rupees last time, and on the actual payment day, what would be that difference? That will also go to the P&L. That's what would happen, isn't it? After the payment, you don't have to report anything.
Sir,
Yes.
so if I say like this, transaction exposure doesn't reflect in the balance sheet, but the translation reflects in the balance sheet. Transaction doesn't reflect. It's correct, no, sir?
Translation exposure
It
is
appears
in the balance sheet. Yes,
yeah,
yes, it appears in the
yeah,
balance
it appears
sheet.
in the balance sheet. The transaction doesn't appear because
Basically,
it's in the local
it's
currency.
not appear. It arises from the balance sheet, you would say.
Yeah. But normally, in the P&L, it shows as
Then whatever the
outstanding
change, it will go to the P&L.
yes. That is in the translation, no, sir?
No, translation, yes.
Yeah.
Transaction, it will straight away go to the. No, it may not reflect in the P&L also.
Yes,
Because
each one doesn't reflect in the P&L, but it shows as a accrued amount in the balance sheet.
transaction.
Yes.
How?
So in the normal local rupee, like if we have liability any outstandings to be settled for the foreign party, it will come in the balance sheet.
That is translation risk.
So
Whenever you have a
translation risk
liability
appears.
towards a foreign party, that it will be
Yeah.
reflected in balance sheet as a liability, no?
Yes.
Then with the time, that value of the liability will change due to exchange rate risk. Whenever exchange rate moves, value of liability in terms of rupees will change.
Yeah.
Then
Correct, sir.
where do you record that difference? Say last year or last quarter, it is liability is 200. Now this quarter liability is 205. Where do you reflect that 5 rupee difference?
Yeah, it will come in the P&L.
It will come in the P&L.
Yeah, correct. I think
That's
a
the
more good
translation risk.
example is say I think for the translation, very good example is if any company is having a subsidiary in another country, how the
Yes.
balance sheets effect for the exchange rate. That is going to be a good example,
yes.
I think.
That is also true. Yes. But
Yes.
again that level of that depends on how there are different ways how to account subsidiaries in your balance sheet, or especially in the how to use the exchange rate. Depending on that, what is the method that you are going to use, the level of risk would vary. However, the risk is there. So when we take a subsidiary, then it will be as an asset. But when we take a foreign currency borrowing, it will be a liability. Either case, the change in value in terms of local currency, that is the risk. That is the translation exposure that you have. Whatever in your balance sheet. But transaction is, you have entered into a transaction with a foreign party denominated in foreign currency. Then you have uncertainty. What is the rupee value or the local amount that you will get? It is sort of a hidden thing, because again it can be converted into again translation risk. If you, whenever you entered into the agreement, if you book it as a receivable, but I don't think you do that all the time. Anything else? Any question? Shall I move forward? So then here, as I mentioned, we are not going to discuss more on economic exposure, but mostly would be transaction risk. How are we going to manage the foreign exchange risk for a receipt, foreign currency receipt? That's the first thing we are going to discuss. Then we'll discuss how are we going to manage the risk of foreign currency payment that you have to make. So in the first example, I have considered a exporter. Exporters have foreign currency receipts. In this case, a tea exporter to Germany. Germany, they use euro, so therefore the contract is in euros. Assume they are expecting euro 5 million. So therefore, German buyer will pay the local exporter in euros. So the exporter entered into the transaction on July 15th, and there's a 3 months period where you get the cash flow for the proceedings of the transaction. So the trade is on T. So you entered into agreement to sell some tea and receive whatever the amount. If it is between two local parties, there won't be any exchange rate risk, because the seller will agree, seller and buyer will agree in rupees. The price is in rupees, not in foreign exchange. So whenever you say it's rupee 5 million, there's no risk. After 3 months, you will receive rupees 5 million. You take the risk of risk of the other party, whether that party will pay that 5 million rupees or not. That's the credit risk. You take that credit risk. You will take some precautionary actions to mitigate that. We'll discuss those later. Other than that, there is no risk. But in this transaction, especially when, as explained here, the local party is receiving foreign currency. The local party has priced the product in foreign currencies, but whenever the exporter receives that foreign currency, he has to convert it into rupees, local currency. We don't know what would be the exchange rate would prevail by the time that the exporter receive foreign currency. It may be more than the current exchange rate, or it may be less than the current exchange rate. So therefore, that risk is there. That is a transaction risk. What are the ways the exporter, Sri Lankan exporter, what are the options the Sri Lankan exporter has to mitigate that risk? Before that, first we have to identify what is the risk. Say on July 15th, Euro LKR rate is say 240. What is the risk for the tea exporter, Sri Lanka, on October? This rate goes to 235 or 245. What is the risk? This is the exchange rate as on 15th July. What is the risk to the Sri Lankan export?
235.
235. Because by the time he received this foreign currency inflow and he's trying to sell it in the market and get rupees, he will get a lesser amount. But if it is 245, he's happy. He will get more rupees. So basically the risk is rupee appreciation, isn't it? That's the first thing that you have to identify. What is the risk? You can't just say exchange rate risk. Yes, true. That's the exchange rate risk. But what it is, whether it's the local currency appreciation or the local currency depreciation, then only you can find a proper solution. What are the options available? What are the instruments that we learned can be used to hedge this risk? There are few, and what are those, and what are the pros and cons or advantages of or disadvantages of doing that?
So can entered into a forward rate exchange agreement or futures or option?
Yes, you either you can enter into a forward contract or a futures if it's available, or otherwise you can enter into a option transaction. So whenever you say forward, what you would like to do in a forward transaction or in a futures transaction, both would be the same. Then when you say option, what type of option that you want to use, and whether you want to buy the option or whether you want to sell the option. You have to be specifically mentioned that. Otherwise, you should know that. Otherwise, you can't execute the transaction in the
So sell option.
market. You have to go to the market and execute these transactions. Okay, if we take the first option, first alternative, the exporter can enter into a forward contract to sell euro 5 million. Remember, because the exporter is receiving euro. He's not by that means he is having an asset. He's going to receive foreign currency. He is in a long position in euros. What he wants to do, the exporter wants to do, is to sell that euro and buy rupees. So therefore, the first option alternative is to enter into a forward contract, sell euro 5 million, find what is the underlying currency pair, and the amount is specified. Then the question is, this is about the underlying. In a forward contract, you have to specify what is the underlying and the amount. Then you have to say when. What is the forward settlement date? Clear? Then both parties can come to an agreement for a rate. This is the rate that you derived based on the equation that we used. Practically, the banker will quote this price to the exporter. Clear? Is it clear? Any questions on that? So when do you do this? Somewhere before October 15 and would be very much closer to July 15th, after July 15th, maybe exactly on 15th of July or maybe after that, depending on your market expectation. So then what do you do on October 15th? As the exporter, what do you do? What do you do on October 15th?
So sell the euro and get the rupee.
Yes, you don't have any other alternative because this is a binding contract. You have to meet this requirement. So that the importer from Germany, they will pay your bank euro 5 million, then bank will keep it and give you equivalent amount of rupees, which is equivalent to 187.75 into 5 million. You will receive this much of rupees. What are the advantages? What are the disadvantages?
If the rate goes up, he lose some amount, no?
Yes, there's an opportunity cost. If the rate goes up, then say on this date, maybe the exchange rate maybe 200. But still you have to sell it at 187.75. You lose that opportunity. What's the advantage here?
If the rupee is appreciated, so it will be benefit.
If the rupee has appreciated, that means the exchange rate is somewhere 170 or something like that. Still you get this rate. So while you are protecting your downside risk, you give up your upside potential as well. That's the trade-off in a forward contract.
If rate goes to 200, the profit, who earn the profit? The bank can retain the profit.
In this trade, who is going to make that money?
Bank earn a profit,
Yes,
no? Exchange profit.
because bank borrows something at 187.75, whereas the market value of that asset is 200. So the bank takes that profit. So that's the risk. Whenever you enter into a forward contract, you should know this. On October 15th, you can't blame your treasury people. Why did you agree to sell this at 187? We could have sold it at 200 today. You have done some misconduct or something like that. Only thing you have to make sure whether this pricing is correct. Whether this is the price prevail at the time when you entered into the contract. If it is fairly done and you took a decision to hedge your position, your risk, then you can't blame anyone. Had you forecasted the exchange rate properly, if you had forecasted this euro rupee exchange rate is going to be 200 by October or somewhere else, and say chance of 90% of happening these and 10% of happening these, what do? So say your research department comes with this sort of a outcome. Then you can make a call. Do we have to hedge, or do we need it or not? If there's a 90% chance, would be better keep it unhedged. But there's a risk. So that's why you have to take a calculated risk there. But once you decide it, and this happens, you can't blame. Is it clear? So whenever you enter into a forward contract, that gives you a or reduce your or eliminate your uncertainty. You know what is the cash flow, what is the amount of rupees that you are going to get. You eliminate the exchange rate risk, whether it's going up or going down. You eliminated it. You are sure I'm going to receive this much of rupees. So normally a business or exporter, they should not try to trade on foreign exchange because it's not their business, or they are not expert in it. So better you do your business, you take your margin properly on this trade. Definitely when they enter into this transaction, definitely they have incorporated their whatever the profit margin, 20% or 30% or whatever, that profit is there. The tea exporters business is tea. So then whenever once you hedge it, you have that profit. But if you don't hedge it, then you may not get that profit, or you may get more than that depending on the foreign exchange movement, but it's not your business. You do, say you are not expert on that, so therefore you should not take that call. But if you want to do that, then you need a proper treasury, proper staff to do research and come up with forecast on exchange rates. Then you can do that as the export. Okay, anything else?
Sir, in Treasury, who is doing this forecasting of this?
In the bank.
Yes.
In the bank, there should be some economist or the research desk doing these forecasts and things. Even the traders, they do their analysis and come up with forecast depending on the market prices they observe and information received from through the market. The traders view may be completely different from the research unit.
Research department also attached to Treasury, or is there some other department?
It can be part of Treasury. It's not a mandatory thing to be a part of Treasury, or mandatory thing to be out of Treasury. Only thing is neither traders should not influence on the researchers, or researchers should not influence on the traders.
But the trader should take the decision based on
Yes,
their.
yes, that's their call.
So that contract date for the receive money is 15th October. If there is any delay, that means that subject 5 million will receive the bank on 30th October. Will take 15 days delay because of any other reason or any market condition. Then what would be the bank position? Will they discount this price or this rate, or
That
they
depends
will
on
charge
the.
additional amount?
No, on only thing is that you may roll over your position. That means, say, for whatever reason, now the exporter realized that, even the bank realized that they are not going to pay, or on October 15th they won't receive this. Then they can enter into a new forward contract till 30th of October for another 2 weeks, so something like that.
Because that bank is having some other transaction against this export proceed, might be having
Yeah,
some.
that can happen. That yes.
They might hit these funds with the importer,
Yes,
no sir?
yes.
In such a situation, bank will be in a problem because
Yes.
bank will be short of euro, no sir?
Euro, yes. Anything else? Shall we move forward? So this is what the exporter would do or has to do on October 15th, and they will receive 938,750,000 rupees. This is a must. You can't avoid this or refuse this. Then the second option is on the option. What is the option that the exporter should enter into? Is a put option. Why? Buy a put option. What are the rights or obligations the buyer receive when the exporter buy a put option? What are the things the exporter can do? What are the rights? What are the obligations? Basically, what is a put option? What is a put option?
The buyer export has the right to sell.
Yes, it gives the buyer buyer of the put option right to sell the underlying asset at the strike price. So what is the underlying asset in this example? It is the exchange rate of Euro LKR. The worry of the exporter is if this exchange rate goes down. So that's why he prefers to sell it at 180. Even if it goes to 170, still he gets it at 180. That's why the exporter buys a put option. So you have to be specified, buy a put option to do what? Sell euro 5 million. You have to say, oh, no need to say sell. Whenever you buy a put option, you know that. Only thing is, what is the underlying euro and the notional amount and the strike price and the expiry date. Those are the terms of a option contract, whether it's a put or a call, and whether you buy or sell, what is the underlying asset, what is the notional amount, what is the strike price, what is the expiry date, and whether it's a American style or a European style. Those are the things that you have to specify in the contract. So you know all those things, but here what you have to identify, since you have a long position in foreign currency and your risk is appreciation of local currency, that means exchange rate is going down, and what you want to do is sell your asset, that is euro. So therefore you should buy a put option. That is what you should be able to identify. Whenever this description is given, you should be able to analyze this and identify what is the risk, exact risk, not just exchange rate risk. What is the exact exchange rate risk, whether the currency appreciation or the depreciation. Then what should be your action? Whether you buy a put option or whether you buy a call option or whether you sell a put option or whether you sell a call option. What is the notional amount? What is the strike rate? What is the expiry? That you should be able to decide. Okay, is it clear why this Sri Lankan exporter buy a put option? The reason is clear. Yes. Is it clear? So simply by now you should remember, so you should know, be clear on what is a put option and what is a call option. If you cannot remember that, that's a different story. So because you should know the product before you use it for risk management or hedging purposes. So here what we discuss, different scenarios, identify what is the risk and use the known products in mitigating those risks or hedging that risks. So here the risk is rupee appreciation. The Sri Lankan exporter has the foreign currency asset. The worry is, or the risk is, rupee appreciate against the foreign currency asset, foreign currency. So therefore, the exporter wants to protect its downside risk. To do that, that means the exporter wants to sell the foreign currency, therefore buy a put option. Then what would happen on October 15th? What would happen on October 15th? Okay, before that, say on July 15th, when the exporter buys this transaction, or buy this option, what he should do, the exporter would do or needs to do. To buy the put option, at the time of purchase, what do you do as an option buyer?
Pay a premium.
Pay the premium. So you pay the premium. Okay. On October 15th, what do you do? Expiry date, what do you do?
See the exchange rate on that date.
Sorry?
See the exchange rate on that date.
Mm-hmm.
Then it has gone down, only we exercise. If not, we will not exercise.
Yes. On 15th October, you have to find out what is the exchange rate. If it is below 180, then you exercise your right. Correct? But if the rate remains somewhere here, or above 180, then you don't exercise your right. What do? You go to the market and sell your euro at the market rate. That flexibility is there. That's the advantage of buying a put option over the entering into a forward contract. If you enter into a forward contract, you don't pay anything on the or at the inception of the transaction, initiation of the transaction. You don't pay anything. But your hidden cost is you give up your upside potential. Meantime, you minimize your downside risk. But in a put option, you pay a premium. By paying a premium, you keep your upside open, flexibility. If the market moves in your favor, you can get that advantage. But if the market moves against you, still you can do the trade at the agreed rate. So at this 180 rate. That is the advantage of entering into an option contract over the forward contract. But whenever you choose between these two, you have to think about the premium or discount in the forward rate and the premium that you have to pay in this option. That you have to compare and decide what to do, whether paying this premium is worth. That you have to be careful. Any question on this? Is it clear why do we buy a put option? Okay, if we go back, the alternative one, here we discuss only a forward contract. Assume there's you can do futures also. What's the difference? You can enter into futures as well. What's the difference between entering into a forward contract and a futures contract?
So the product is standardized and unstandardized. They pick foreign exchange
Yes, the
forward agreement.
futures is standardized. That's true. No, what is the advantages?
And
What are the advantages or
settlement,
disadvantages?
we can avoid the settlement.
You can avoid the settlement.
The
What does it
settlement
mean?
because it's done through exchange base. Because they have to keep the margin and so on, so they can avoid the settlement risk.
No. Let me put it that way. If you enter into a forward contract, it is just the agreement between two parties, the exporter and the bank. By October 15, for whatever reason, the bank may not exist, or bank may fail to honor its obligation. That credit risk is there. Very minimal, but it is there. But when it comes to a futures contract, futures are traded through an exchange, so you face the risk of futures, and it is very negligible. We assume there's no risk of the exchange, so therefore there's no credit risk or the counterparty risk whenever you enter into a futures contract. But on the other hand, you have to make for a forward, you don't make any payment until the maturity date. On the maturity date, you deliver your euros, the bank will deliver you rupees. But in a futures, it's not like that. You have to maintain margin. On the very first day, you have to keep the initial margin. Then depending on the market movements, you can you may have to place variation margin depending on the market movements. If it is moving against you, then you may have to or replenish your margin account. Put in more money into the margin account, the variation margin they call. So there's a small funding cost in that. That is the disadvantage. But there are few more advantages. Say in this case, you sell a euro. Oh, here you have to do, sell a futures contract, isn't it? Because you are protecting the downside. Say you sell a futures contract at 187.75. You may not be able to get the exact maturity. That's another problem. Futures contract may be expiring in November or somewhere. That's the disadvantage. It may not gives you your amount and your value date. So therefore, you have to be careful on that and select a suitable futures contract and very close to the amount that you need. Not only that, say after you sell futures contract, assume the exchange rate went down, say it went to 175. Now you feel this will bounce back and come up before October 15th. If you want, you can buy a futures contract here at 175 and book the difference between 187.5 and 175 and keep your position open now. Then whatever on the maturity date, again you can sell your euro at the market price. But remember, you took this profit, then after that you're exposed to the risk. If it goes beyond this, you will lose that opportunity. Then you have to sell your euro at that rate. However, some flexibility is there if you have a good forecast and to play around your wheels if you go with futures. But when you enter into a forward contract, you can't do anything. Only thing you can do, you can enter into another forward contract with another party or maybe with the same party. Then it will be considered as two different contracts. But in futures, it is not the case. But all those things depends on what is your intention. If you want to hedge your position, completely eliminate exchange rate risk, you should not try to trade like this. You sell the futures, hold it until maturity or until you get your cash flow and you sell it in the market. On that date, you can buy the futures contract to get out from the market because your transaction is completed. But if you want to maximize your profit by taking some risk, then you have that flexibility through futures. Through forward, it is not easy to do. In alternative 1 and alternative 2, you can completely hedge your position, eliminate your foreign exchange rate risk. If market moves against you, you would still get the contracted price, full amount. But this alternative 3, this is also one option available for you, but it won't hedge the position as of doing or buying a put option or selling a forward contract. Here what do? You sell a call option. Then what is your position when you sell a call option on euro? You are receiving euro, you sell a call option. When you sell a call option, what is the right to the buyer?
Right to buy.
The buyer has the right to buy. As a seller, if the party asks, you can sell. Okay, now let's see. This is 188. This is the strike price they have agreed. What would happen if exchange rate goes below this? If exchange rate goes below this, below 188, what would happen? Will the buyer come and execute his right?
No, sir.
No. But you have your euro 5 million. What do you have to do? You have to sell it at the market. Then you will sell somewhere here, say 180. So is your downside protected properly? No, because the exchange rate has gone down, the rupee appreciated. You have to sell it at the market price. But apart from this, what do you get? 180 rupees. Apart from that 180 rupees, you get another cash flow. What is that? When you sell a
Get a
call
premium.
option, you get the premium. So then it will be somewhere here. Effectively, you may be selling at 182 or something like that. But if the exchange rate goes to somewhere here, you sell it at 188 because the buyer of the option will come and execute his or her right. So you have to sell euro at 188. So you give up your upside. But you sell it at 188, still you have that another 2 rupees or whatever premium, then 190 or something like that. So this is also a possible way, but it may not give you a 100% protection. If you think market won't move drastically, but the premium will give you some enhancement, this is also a possible solution. But as I mentioned, whatever the solution that you select, first you have to analyze your situation, analyze the market, come up with a view on the market, justifiable view on the market, then enters into the transaction, considering all the alternatives and which gives you a best outcome as per your views and the market conditions. Then stick on to that, knowing that it can go other way around, and if that happens, what would be the worst case? What are the repercussions? You should know that in advance. If I do this, this will happen. So all the parties should be aware about that. Even when you propose something to a customer, you should inform the customer or enhance the customer's knowledge on this. If you do this, this is your outcome, this is your upside, this is your downside. You should explain this. Otherwise, after the event, after the fact, they will come and try to find fault with you and sue you. So don't keep any opportunities for that. Any question? If not, shall I move forward?
Sir, options are not available in Sri Lanka. No?
There are some banks you can do options.
Not every bank. No?
Not every bank, yes.
Okay.
So far we discuss from the exporter's point of view. That means when you have a foreign currency receipt. So even though I took the example of an exporter, no need. So the basic concept is you have a foreign currency receipt. See, even a borrower in foreign currency follow one of these steps or the options. Use one of above options to hedge borrower's risk, because it's a receipt of foreign currency. Just the risk of converting the foreign currency amount to rupees, not the interest rate risk or the future exchange rate risk the borrower would face on the maturity date when the borrower repays the loan. Not that, but only on the receipt to convert that amount, foreign currency amount into rupees. One of these alternatives can be used. Now we'll move into the other side of the story. That means whenever you have a foreign currency payment, that means you have to make a payment in foreign currency. You are in a short position. You are about to buy foreign currency. You need to buy foreign currency on a future date to meet the obligation. Then what are the alternatives we have? Again, what are the pros, what are the cons? Again, here I have considered a importer, Sri Lankan importer, because when you import goods or services, you have to pay in foreign currency. So the contract is entered into on 15th August and the payment date is on 15th November. You have to make the payment on 15th November. You agreed the contract for the purchase of the underlying good, the copper wire, on 15th August. What is the risk? What is the risk?
The risk of depreciating the currency.
Risk of
Depreciating the exchange rate.
Yeah, depreciation in what currency?
Local rupee, LKR.
Local currency. Depreciation of This is the risk. If rupee depreciate against dollar by 15th November, the importer has to pay more rupees to buy dollars. What are the possible alternatives, or what are the available products to hedge that risk, eliminate that risk? What are the possible solutions? Now, what do you want to do? Buy. The requirement is to buy USD. The risk is depreciation of currency. What are the options? If you go back to the previous example and think about it and link it to the current situation, you would find the solution. So in the previous example, that means whenever you have a foreign currency receipt, we had three alternatives. Sell a forward, buy a put, sell a call. So now we are on the other side of the transaction. We are receiving foreign currency. Sorry, we are making a foreign currency payment. That means we need to buy foreign currency. Then think if we are to use forward or futures, what we should do. Or if we want to use options, what are the possible alternatives, avenues available?
So forward exchange, intend to forward exchange to buy foreign currency.
So basically, what do we call it? Buy a forward. That means you enter into a forward contract to buy the underlying asset. Or it can be a future. So these are sort of identical, only differences in the operation. In the futures, you have to maintain a margin account. In forward, which you don't have to do. First option is you can buy a forward contract. So you fix the exchange rate today and the transaction is settled on the 15th November. What is the second option? If you want to buy something, the risk is if the price goes up, what sort of option that you would like to use?
Buy a call option.
Buy a call option. So buy a call. If the price goes beyond that, still you can buy the underlying asset at the strike price. You don't have to worry about the price increase. Then third option, but the third one, it may not hedge or give 100% hedge. Still you will take some risk. Yes, what it is?
Sell a put option.
Seller put option, assuming or by doing that, what do you try to create a cushion equivalent to the premium that you receive. You try to enhance your cash flow by an amount equivalent to the premium that you receive. So your negative or your loss will be minimized or reduced by that amount. That's what you are going to do in that case. Okay, these three answers are correct. These are the basic that you can do. We'll go one by one. As we discussed, the first alternative, the importer would enter into a forward contract to buy $500,000 because that's the contracted amount. It should be November. Because in this it says 15th November. So forward contract should be to buy $500,000 on 15th November. The agreed rate is 186. Then on 15th of November, what do you do? As the importer, what do you do on 15th November? You pay rupees 500,000 into 186 million to the bank, and bank will make the payment of $500,000 to the exporter in China. In this case, or especially in this case, in the Sri Lankan context especially, you may have to keep a margin depending on the relationship you have with the bank and the regulatory requirements and things like that. Even though it's a forward contract, you may have to keep a margin. It may be 100% or 10%. That depends on the circumstances. But theoretically, you should not incur any or make any payment at the inception of the transaction. But to minimize the credit risk, this is required. Any question? If not, again, what are the pros and cons? What are the advantages of entering into a forward contract in this case? And what are the disadvantages?
So you can minimize the upward trend, appreciation of
Yes, you you can fix your cost. You know what is the exact amount that you have to pay. So you eliminate your uncertainty. You know exactly what is the amount that you are going to pay. What is your cash flow requirement as of on 15th November? Or on 15th November, I have to make a payment of $500. For that, $500,000 into 186. That is the amount that you have to pay. It's known. Your life would become easy. If you don't hedge it, you don't know what would be the amount that you required on 15th November to buy $500,000. But once you enter into a forward contract, you know exactly this is the amount I need. Irrespective of the exchange rate prevail on 15th November, you know what this is the amount that I have to pay. So in a way, you completely eliminate your foreign exchange risk, and you make it certain that is there. That's the advantage. And the other thing is, compared to for futures, your exact value date can be considered, your exact amount can be considered or taken into account in this product. And theoretically, you don't have any cash flow requirement before the expiry of the contract, but practically you may have to keep a margin with the bank to minimize the credit risk or the risk to the bank. The other disadvantage is you give up if the exchange, the opportunity that you can buy dollars at a lower rate if the exchange rate goes down. You give up that opportunity. Meantime, you protect the risk of paying more if the exchange rate depreciates. So that is about this forward contract. If it is a futures contract, still you buy a futures contract. Again, the same problems will be there, whether you will be able to find exact maturity or you go for the next nearest. Generally, that's the case. You don't get a shorter version or a short maturity than your required maturity date. You go for the longer maturity of a futures contract than the maturity of your transaction. So since this is 15th November, if you don't have a futures contract maturing on 15th, but maybe on the third week of November, if there's a November delivery futures contract, you go for it. But if you don't have a November delivery contract, there's a December delivery contract, you go for that. You don't go for a October delivery contract. Generally, that's the practice. So if you are to use a forward futures contract, that risk, because now then you face the basis risk when you go for a futures contract, that risk is there. Other than that, it will hedge your position. Not only that, you have to pay premium, pay the margin, initial margin and variation margin during the contract period, but you can avoid the physical settlement depending on the type of the contract that you have agreed. That depends on the contract that you have agreed. However, you can avoid it by doing the opposite side. In this case, you buy a futures contract on 15th November, you can sell the futures contract and close out your position on the futures and settle this transaction as well. So that is the alternative one, how you can use a forward or a futures contract to hedge a currency payment. Then the second alternative to hedge a foreign currency payment is buy a call option. As explained earlier, if the strike rate is 186, if rate moves above here, still you can buy dollars at 186. The exchange rate may be 190 or 200 or whatever as on. Then this should be November, on November 15th. The advantage of this is if the exchange rate is somewhere here, you can ignore the option contract and go to the market and buy it at a cheaper rate. That flexibility is there in a option contract, but to get that flexibility, you have to pay the premium. That's a cost. Clear? So again, I remind you, alternative 1 and alternative 2 both will give you a perfect hedge. You don't take any risk. At least you know what is the best rate that you would, what is the worst rate that you would get. In this case, 186. Best rate would be somewhere below 182 when you trade in an option. But in a forward, you know exactly the rate what you are going to trade. In the third alternative, as we discussed in the previous example, this won't give you a perfect hedge, but will give you a cushion up to the premium amount that you collected, because when you sell a put option or whatever option, when you sell an option, you get the premium. So this is a plus cash flow. This will reduce your cost by up to a certain extent. If the market does not move by a big amount, this will be a plus for you. But the market moves below this strike rate, then you have to buy the asset at that lower rate. Again, make it December. Sorry, make it November, not December. Otherwise, you will get confused. Why do we do December expiry things when the contract is maturing in November? So these are the basics to hedge your transaction exposures. Remember, in all those things, other than in futures, what we do, these are foreign exchange risk, market risk basically. We eliminate FX risk. So that means whatever the risk that may arise due to exchange rate changes, we eliminate that. But while we eliminating that, we took another risk. What is that? Can someone tell me, or have you identified? So initially for these both parties, in the case of importer or exporter, The initial risk was the movement of exchange rate risk, exchange rate, either appreciation or a depreciation, depending on your position, whether you are expecting a foreign currency receipt or whether you are about to make a payment. However, the risk is foreign currency rate or exchange rate fluctuation. Through these products, we can eliminate that risk. But while we are eliminating that foreign exchange risk, we took another risk. What it is? When we do a forward contract, whenever we do a option contract, especially when you buy option contract, when you sell option contract, it is again not there. Especially in the first two alternatives. Alternative 2, buy a put option. Alternative 1, sell
So
a sorry?
So you get the translation risk.
Not that.
Is that credit risk?
That's the credit risk. Yes, exactly. Because we entered into a transaction with some other party. We never know whether that party would honor the transaction on the maturity date. So we take the credit risk. So that is sort of, that's why we say most of the time, generally, using derivatives, what do? We transfer the risk either from one type of risk to another type of risk, or from one party to another party. We don't eliminate the risk. That's what we do. We eliminate one type of risk and take another type of risk. So that is also a very important point that you have to remember. So we didn't have any credit risk, but with these transactions, by entering into any of these, we take the credit risk while hedging the market risk or the foreign exchange risk. Okay, any question? That's all about in that. After the break, we can move into the foreign exchange risk mitigation measures that we use in a treasury or in a bank to minimize the risk. We can discuss that after the break.
Sir,
Yes.
next question, not with regard to this lesson, but in case of yen, how that yen exchange rupees stay low, even the 2 rupees, 3, something like that. How do that happen? So, not like other currencies.
That it's like this. Say, can you remember we discussed cross currency rates and cross triangular arbitrage?
Yes.
Say, so that's the concept. That's why if we take what is the USD LKR exchange rate, say for simplicity, say it's 200. What is the USD JPY exchange rate? Say 105. Then what would be the JPY LKR exchange rate. What's the rate?
$1.9.
How do you get it?
200 divided by 1.
1.9 something.
It's 9
9
0.
0. So that's how. Even why do we have GBP LKR close to somewhere 280? That's again GBP USD LKR rate. Unless otherwise there will be an arbitrage opportunity.
It's that's been a developed country. From that time onwards, it has been same because usually other countries, other developed countries has
Sorry, I cannot hear you properly.
usually other developed countries has a higher, usually about 200, 100 rates now. Why being a developed country, Japanese, how they maintain that sort of rate?
I didn't get your answer. Sorry, question.
Usually, the developed countries maintain higher interest, higher rates, higher exchange rate than us.
What do you mean
USD,
by higher exchange rate?
compared to one Sri Lankan rupees, they have 200. To compare to their currencies, we have to give 200, 100, something like that. The European countries, but how the Japanese yen is keeping them low. But in the case of
Because of this, if you take GBP USD, it is something 1.25 or 1.3 something like nowadays.
in case of that USD JPY, it's that usually the JPY and USD and Euro is about 1 point something like that. But how that 100 power? No, that's a question.
So that's the market dynamics, because what depending on the export imports between dollar and yen. So the rate remains at 105. So sometimes even it goes to 120.
So, but the US says that Chinese yuan, why they are keeping low.
Yuan is around somewhere 6.5.
So the US says that it is they are artificially doing that. So why don't they do to ask for to Japanese to uh, Japan to do?
So that depends. That depends on what are the trade volumes that you have to find, whether Japanese import lot from US or US import lot from Japan. What are the trades between yen and in China and US? So all those things matters. And on the other hand, China, they have a pegged currency. So US imports a lot of goods from China. Therefore, the Chinese exchange rate should appreciate.
Okay, sir. Thank you.
That's the fundamentals. But so that's what Say now the question is why dollar yen is 105? Why don't they maintain it at say at least 10, 20 something like that? Why don't they let it go that side? So 200 rupees. There's a story behind this. Should we keep it at 200 or 300 or 100 or 50? What is the USD Korean won rate? What is USD Indonesian rupiah? If I remember its IDR, I think. Indonesian rupiah. What is the exchange rate? What is the exchange rate? Peso. Philippine peso against dollar. Check those things. Anything else? Compare the Korean won exchange rate and Sri Lankan or dollar Korean won, dollar rupee, and see what are the two exchange rates and in which country the living standard is high. Anything else? If not, shall I move forward? Here, basically, we are trying to discuss. Focus is to discuss on the exchange rate risk faced by banks. Mostly would be sort of translation risk. How to mitigate that. Apart from trade or that may arise due to trading activities. To discuss that, first of all, we have to identify what does it mean by a net exchange position. Then the some of the controls that we have in to minimize the risk in foreign exchange transaction. So indeed, this counterparty and settlement risks are to mitigate some other risk which may arise from the exchange rate transactions. These two are not to mitigate the foreign exchange risk. So what is a net exchange position? In simple terms, we can say net exchange position is the difference between assets in one currency and the liabilities in the same currency. If you take dollars, a Sri Lankan bank, what is the amount of assets in dollars? What is the amount of liabilities in dollars? What is the difference? That difference is the net exchange position. We also call it as the net open position. It's like a sort of a gap analysis what we discussed in gap in, but this involves a currency. Say a bank has dollar assets of 2 million and liabilities of $1.5 million. What is the risk? Say the current exchange rate is 200. What would happen if this exchange rate goes to 201? And what would happen if this goes to 199? Or does it matter, the exchange rate? Is this something we have to worry about? What do you think? The Sri Lankan bank is a Sri Lankan bank having foreign currency assets and liabilities. The bank has foreign currency assets worth of $2 million and liabilities of 1.5 million.
Rates going down, so that means 199, it is a risky for the bank.
If exchange rate goes down to 199, it is a risk for the bank. Why?
We are having more assets than liabilities.
If we translate this into rupees, 2 million into 200, it would become LKR 400 million. Correct? 2 million into 200, 400 million. If we convert this liabilities into 200, 1.5 million into 200, we get rupees 300 million. As a Sri Lankan bank, balance sheet should be in Sri Lankan rupees. So these are the rupee amounts as of today. What would happen to these rupee amounts if the exchange rate goes to 201? This would become 402 million. Correct? What would happen to the liability amount? It would be 298.5. Sorry, it's going up. It would be 301.5 million. Is it correct? If the exchange rate moves from 200 to 201, what would be the balance sheet for the corresponding line items for these two foreign currency assets and liabilities? So asset value increases in terms of rupees, liability value increases in terms of rupees, but the value of asset increases more than the value of liabilities. Here the gain is 2 million. Here it's only 1.5 million. So what is the net change? Plus 0.5 million. Is it a gain or loss? Whenever I say plus 0.5 million, asset value increases, liability value also increases, but asset value increases more than the increase in liabilities. Is it a gain or a loss?
Gains.
It's a gain. So there will be a profit of 0.5 million in the P&L. But what would happen if exchange rate goes to 199? This would be 398 and 398.5. So it will be a 0.5 million loss. Clear? So what matters is the difference between these two. $0.5 million difference is there, plus difference. Asset value is higher than the liability value. In dollar terms, there's a positive difference. So when the exchange rate goes up, rupee value of this 0.5 million goes up. So it will be a gain. If the exchange rate goes down, this value goes down by 1 rupee. So 0.5 million. It's a loss. So therefore, the exposure, this 0.5 million is the amount we put it at the risk. Others are moved in tandem together, so it won't create any profit or loss, but that difference will create a profit and loss. So that's why we worry about what is the difference between assets and liabilities in foreign currencies. Is it clear? Is it clear? If I change this to 1.5 million assets and 2 million liabilities, what would happen when the exchange rate goes to 201 and 199? Would it make any difference?
So when the currency depreciated, loss going to be more. So.
Yes, when currency depreciated, that means when the exchange rate goes up to 201, now it will generate a loss of 0.5 million, but in the previous case, it was a profit. Now this case, it will generate a profit. So can you see a similarity between gap analysis and the net interest income and the net exchange position and the profit or loss, exchange gain or loss? the same thing, but no, two different variables, interest rate and the exchange rate. So what matters ultimately is the difference between assets and liabilities. That amount is sensitive 1-to-1. For a 1 unit of exchange rate appreciation or depreciation, profit or loss would change by the net open position times 1. So sensitivity is 1-to-1. Whether it will give a profit or loss, that depends on whether you have more assets than liabilities or you have less assets than the liabilities. So which is here we call as net exchange position or the net open position. In Sri Lanka, we mostly use this NOP, net open position, but than the net exchange position. NOP is the familiar word for us. That's why we worry about that amount. What is the net exposure to the exchange rate risk? What is your net open position? Is that clear? Any questions? Here we simply say assets in a currency and liabilities in the same currency. But say assets and liabilities may mature in different time period. So in that scenario, what we do, we calculate the present value of all assets and the present value of all liabilities and take the difference. That would be the much better proper definition for a net open position.
So, excuse me, I have a question.
Yes.
Yeah, when currency goes up to 199, when assets are more than liabilities, can you explain that scenario again?
Okay. And that scenario, we had 2 million assets, 1.5 million liabilities. If the exchange rate goes to 199, what would this is when we have the exchange rate at 400, 200. Now we assume exchange rate moves to 199. Now what would be the value of assets when the exchange rate is 199? It would be 398 million in rupees. Is it correct?
Yeah, okay, sir. That's
Okay.
correct.
Then when we convert 1.5 million dollars into rupees at 199, what is the figure? It would be 298.5. Correct? Is it correct?
in that case also, it's a gain, no, sir?
How?
Uh,
What is
assets
the
are-
what is the difference between 400 and 298? It's minus 2. So difference in assets minus, what is the difference here? Minus 1.5. The difference would be minus 0.5. Whereas your asset decreased by 2 million and liabilities decrease only by 1.5 million.
it's a loss, no, sir?
It's a loss.
Loss, yeah. Okay. Got it, sir.
I
Thank you.
think I did a mistake in the previous. I mentioned it. I think I wrote it as 298.5. Here, instead of 298, I wrote it as 398.5. I think, if I remember. That's a mistake, however. It's not just the difference between these two, whether it's a profit or loss. It's the drop in the, or drop or the gain in the asset value, or drop and the gain in the liability value. What is that difference? Okay, now is it clear?
Yes, sir. It's
The
clear now.
same thing, 400 to 402 and 300 to 301.5. Asset increased by 2 million, liabilities increased by 1.5 million. So net is 500,000 increase in value. So as we had negative gaps and positive gap, net open position also can be a negative or a positive figure. When we have a positive net open position, that means when we have more assets than liabilities in one currency, we call it a long position. You have a long position in that currency. Remember that when you say you have a long position, it should refer to a particular currency, because this is a relative thing. I'll explain with this example. The difference should be a positive amount, and the assets in that currency should be more than liabilities in that currency. We call it a overbought position as well. That means you have bought more assets than creating liabilities. So long position or a positive position or overbought position, everything refers when you have more assets in one currency than the more liabilities in that currency. So if we take that dollar yen example, dollar yen as an example for two currencies, this is the balance sheet composition given. In the asset side, there are more dollar assets and small portion of yen. But on the liability side, less liabilities in dollars and more liabilities in yen. Now, when we calculate the net open position in dollars, we consider only the assets in dollars and liabilities in dollars. So in this case, you would get a long position in dollars because you have more assets than liabilities in dollars. Is it clear? You have more assets in dollars than more liabilities in dollars. So the net or the difference is a positive figure. But if we take the same balance sheet, but if we change the currency to yen, what would happen? We have less assets in yen and more liabilities in yen. So therefore, in yen, assets minus liability value would be a negative figure. In this, we call it's a negative position or a short position. But remember that depends on the currency that you use. In this scenario, in terms of dollars, dollar assets are higher than the dollar liabilities. Therefore, you are having a long position or a positive position in dollars. But in this balance sheet, you have less assets in yen, more liabilities in yen. So therefore, you have a negative position in yen. So what I'm trying to say, whenever you have long position in one currency, definitely you should have short position in another currency. Long position in one currency will get offset or back by a short position in another currency. That has to be there. Is it clear? In this slide, it's a short position, but in yen, not in dollars, because you have more assets in dollars, less liabilities in dollars. In dollars, it's a positive position, but in yen, you have less assets, more liabilities. In yen, it's a negative position in JPY. So that's why I mentioned the currency is important. Whenever you say you have a positive NOP or negative NOP, it should be clear about the currency that you are talking. But in the Sri Lankan context, we mostly trade in dollars, or we have more assets and liabilities mostly in dollars. And whenever we say NOP is positive, that means in dollars, not in rupees. You generally express the net open position in a foreign currency amount, not in the local currency amount. But definitely, whenever you go long in foreign currency, you go short in local currency. Whenever you go short in foreign currency, you go long in local currency. So the third position is square position. That means a zero gap. That means there is no difference between assets and liabilities in foreign or whatever the currency. Assets and the liabilities are on the same amount. We call it a square position. So basically, a net exchange position can happen whenever we fund one asset in a one currency and using the liabilities of another currency. Like we did, long-term assets are funded with short-term liabilities. We fund dollar assets using rupee liabilities. That can happen. So then there will be a mismatch. There will be a net open position. And the second bullet point explains why when we have long position in one currency, we have short position in another currency. That because of, as again we go back to our fundamental equation, assets and liabilities should match. So whenever you have more assets in one currency, you should have more liabilities in the other currency equivalent to the same amount. That's why when we are going long in one currency, we are going short in one or more in other currencies. So as I explained at the very beginning, the exposure to the exchange rate can be measured through the net exchange position, because that drives the profit or the loss for a moment in the exchange rate. If exchange rate appreciate, whether we'll make a profit or we'll make a loss, that depends on the net exchange position or the NOP. If the NOP is positive and that currency appreciates, you make a profit. If the NOP is negative in one currency and that currency depreciate, then you make a loss. So that's the basic I explained earlier. So this summarizes here. Assume you have a long position, profit from revaluation. Assume you have a long position in dollars. You are long $1 million against USD at 186. So that means you have more assets than liabilities, $1 million. Current exchange rate is 186. What would happen if dollar appreciates against LKR to 187? Dollar appreciates against LKR, so the exchange rate moves from 186 to 187. What would happen? Value of this excess assets in dollars will go up in terms of rupees. It is 1-to-1. 1 rupee change in exchange rate, 1 rupee change in the rupee value of the dollar amount. So that will give you a gain of 1 million rupees. But when you have a long position in foreign currency and foreign currency depreciates, you will lose. For a drop in 1 rupee, your loss would be 1 million rupees because you had a long position in dollars. So that's the basic summary that you have to remember. Profit from one currency, long position in one currency and that currency appreciate, you make a profit. Long position in one currency and that currency depreciate, you make a loss. That profit or loss would be 1-to-1 with the exchange rate movement. 1 unit change in the exchange rate, you will get a 1 unit gain or loss. Then whenever you have a short position, you have a short position in dollars, 1 million. The exchange rate is 186. But rupee appreciates or the dollar, the foreign currency depreciate. There you have the short position. What would happen? You make a profit. But on the other hand, whenever you have a short position in foreign currency and foreign currency appreciate 186 to 187, you had a short position, then you make a loss of 1 million rupees. That because of your position was 1 million. If it was a 0.25 million, what is the loss? You had a 0.25 million short position in dollars and dollar depreciated by 1 rupee, then your loss would be 1.25 million rupees. Is it clear? Not a big calculation. Take the net open position and take the whatever the change in the rupee amount and apply that change into the net open position amount in the net open position. You get the profit or loss in local currency, in terms of local currency. Remember, you get the profit or loss in terms of the local currency, not in terms of foreign currency. Any question? Any questions? If you don't have any questions, I'll move forward, and this is the summary of it. So in this balance sheet, you can see more yen assets than yen liabilities. So in terms of yen, you have overboard position. If JPY revalues, you make money. If yen devalues, so that means yen depreciated, you lose money. But the same balance sheet in terms of dollars, you have a oversold position in dollars. So therefore, if dollar revalues, you lose money, or that means if dollar depreciate, you lose money. If dollar appreciate, sorry, you have a short position or the oversold position in dollars. If dollar appreciate, you lose money. If dollar depreciate, you make money, or you make a profit. In the lower part resembles the same thing, but by switching these two diagrams other way around. More assets in dollars, less assets in yen. Less liabilities in dollars, more liabilities in yen. So in terms of dollars, you have a long position, overboard position. If dollar appreciate, you make money. If dollar depreciate, you lose money. On the other hand, in terms of yen, you have more liabilities in yen. So you have a short position in yen, negative position in yen. So therefore, if yen appreciate, you lose money. If yen depreciate, you make money. Any question?
So we can calculate that loss of profit from the exchange rate revaluation or devaluation from the net amount multiplied by the exchange rate difference, right?
Yes, but we have to calculate net amount, net position multiplied by the exchange rate difference. You will get the amount, the loss or profit amount. But whether it's a loss or profit, then you have to think about what was your position, what was the move. If you had a long position and the currency appreciate, then it's a profit. You had a long position, currency depreciate, then it's a loss. Clear?
Yes, sir. It is like same as that we calculate last gap question. Question.
Yes, same as the gap
Last
calculation. On the other hand, if you use the NOP with the sign and the change in the exchange rate with the sign, then it will straight away give you whether it's a profit or a loss. If you get a plus amount, it's a profit. If you get a negative amount, it's a loss. You can use NOP is positive, then put in plus figure. If NOP negative, put the negative figure, negative 1 million. Then put negative 1 million into the difference in exchange rate. 101 to 102. Then 102 minus 101. It's a positive move. Ultimately, you get a negative answer. That means it's a loss. That you can do that way as well. Anything? So with that, now you know, like we expect, or we place our balance sheet in different shapes or different exposures to different maturities in assets and liabilities based on our interest rate expectation. What we want the interest rate. Likewise, we can place our balance sheet for the exchange rate risk as well. What is our view? Then what should we do? What should be our strategy? So when you think foreign currency is in an appreciating trend, what do? When you think foreign currency will appreciate in the future, what do?
Make a long
What is your
question.
strategy? You try to buy and keep more foreign currency asset. So have a long position, positive net open position. Then when the currency appreciate, you make a profit. But remember, if your view is not correct, if the currency depreciate, then you make a loss. So your view and the real market, actual market move may be two different things, and that will drive your profit or loss. But on the other hand, if you think foreign currency will depreciate, what do? If you think foreign currency will depreciate in the future, you try to maintain a short position in the foreign currency. You sell the foreign currency at a higher rate and try to buy it back when it goes low. Then you make a profit. But again, instead of depreciating, if it appreciates, then you make a loss. So however, that's the strategy that you would follow depending on your view. If you think foreign currency will appreciate, then you should go long. If you think foreign currency will depreciate, then you should go short. That means have more liabilities than assets. Is it clear?
Yes, sir.
Now you can see. So if you think, okay, foreign currency will appreciate and I should go long, you keep buying foreign currency and accumulate foreign currency asset. But your view is wrong. Market goes other way around. Then you will incur a huge loss. So it can be a bearable loss or it can be a non-bearable loss. So therefore there is a risk. To mitigate that risk, what we do, we put controls on this net open position. What is your net open position? You cannot have an open position beyond that limit because the risk is too much. If your view is incorrect, it will generate a huge loss. So from the risk management perspective, the bank imposes this net open position limit. And that limit can be applied on the overnight limits or basis or the daylight limits. In some banks, the both are same, or in some banks, they impose more two different limits. What does it mean by overnight limit? At the end of the day, before you go home, you cannot have, say, overnight limit is plus 5 million. At the end of the day, you cannot have a open position, a positive open position more than $5 million. You should be at least 5 million or less than, or at most 5 million and less than that. This is from the positive side. There can be the same limit on the negative side as well. That means on any day, end of the day, your position should be within plus 5 million to minus 5 million. You can go long, maximum up to 5 million. You can go short, maximum up to 5 million. You cannot go beyond that. But having said that, I would like to highlight it should not be a symmetric limit like this. It can be plus 5 but minus 2, depending on the bank's view on the exchange rate. You would have this kind of limit structure when you don't want to go short more than 2 million. Why? You think there are more chances of foreign currency appreciation than the depreciation. So therefore you should not have big short position. But yes, since the expectation is to foreign currency to depreciate, you can have little bit high amount of in long position, or it can be other way around. So all those things depends on the market view, or the not the market view, bank's view on the market, traders view, and the risk appetite. What is the loss that you can absorb? So depending on that, the bank will impose overnight limits on the trading desk or the as a whole in the for the bank. You cannot have more than certain amount as the open position when you go home at the end of the day, because you don't know what would happen during the night and when you come back to the desk tomorrow morning. So therefore this overnight limit is imposed, and the daylight limit is,
Sir, excuse me, sir.
yes,
Who imposes this limit? It is the chief leader.
it's basically for the risk management perspective. This should be from the bank itself, but from regulators perspective, for different reasons, various reasons, regulator also imposes the limit. So whichever law would be applicable at the end.
The
Bank
regulator
limits
imposes
and
for
the regulator limits, whichever law will be applicable.
the regulator is for whole bank.
No, individual banks.
No, I mean individual banks. Yeah. So individual one bank, there are limits imposed by the regulator. That means central bank.
Yes. For
So
individual
it's
bank.
differ from each bank.
Sorry?
It's differ from the one bank to another.
Yes, that can happen.
So other thing is that within the bank, who imposes that? Is a chief dealer or something?
In
The bank, who imposes that limit?
it should be through the risk management structure. Maybe the risk management committee or ALCO. Depends on your structure.
So during the day by day, it's changing or
Not necessarily, but if you want, you can, or the bank can change it, but not the central bank. Central bank does not change it on daily basis.
the other thing is, if the one dealer has more than that, at the end of the day, some which is above that limit or short of that limit, how we can do that? Can come to that position.
I didn't get that.
Let's say by the if it is we are closing by 3, if one person is one dealer has more above the limit, is above the limit, how can he do that, come to that position?
Before the end of the day, he has to do a transaction with another bank in the market.
So if he can't find another bank, sir?
Very rarely that would happen. If you ask a quote from the market participant, they should give you a quote. If the market is illiquid, so then you should not take that or go beyond that position, knowing that you cannot cover your position. If the market is illiquid, you should not take any bets.
So
So
only
it's,
with the Sri Lankan banks we can do that. Not with other banks also we can do. No?
Sorry,
With other foreign banks also we can do this. We can come to those banks also. Foreign.
dollar rupee transactions we can do on the with the banks in Sri Lanka.
Not
Not
with
with,
foreign banks.
yes. So what do you mean by foreign banks? That's the
Banks in let's say Citibank in UK. Something like that.
no. They won't trade dollar rupee or something, anything related to rupee. You can do dollar yen or something like that.
You can do that.
Yes, but not dollar rupees. Dollar rupees only with the bank which has presence in Sri Lanka.
so is there a control? I have seen, say, USD 1,000 has been bought by a dealer. He has to cover it during the day by selling US dollar 1,000 and cover the position. Is that something? It's a regulation or like?
No, for the dealer level, it comes from the bank itself. Regulator imposes the bank level limit overnight or basically overnight limit.
Okay, so then
But
he has to
but
cover
all
that.
others are dealer level or the desk level. Those are within the bank.
So that means
Because central bank or the regulator does it from the system perspective. If one bank fails due to foreign exchange reason, there will be an impact on other banks, and there will be a calamity in the problems or ripple effect in the industry, in the market. So to avoid that, regulator imposes the limit. So if the bank thinks that limit is also too high, your risk level is not that much, your risk appetite is not that much, bank itself can impose a limit less than the limit imposed by the regulator. So that's for the whole trading desk or the whole bank. It should be for the whole bank. Then that limit you can allocate in different amounts to different desks, the corporate desk and the interbank desk, something like that, and the trader level as well.
So the dealer should cover the position, no, during the day.
Yeah,
That
depending on his limit. If the overnight limit is 0, the open position limit is 0, then he should cover his position. If it is some amount allowed, plus 10,000 or negative 10,000 or 1 million, then he can carry the position for the next day.
okay. So thank you.
Then what I was discussing is the daylight limits. That means within the day, within the business hours, the NOP limit may not be same as the overnight limit because there are transactions going on. You may have to quote for banks, other banks, customers. They will hit you. So therefore, maybe your daylight limits may be slightly higher than the overnight limits, or maybe the same. Again, that depends on the bank policy. However, if the daylight limit is higher than the overnight limits, by the end of the day, you should bring your position within the overnight limits. During the daytime, you can keep it within daylight limits. Is it clear? Daylight means within the day, within business hours. What is the net open position limit? But overnight limit is at the end of the day, what is the position that you can carry for the next day. That is the basic or the simple rule imposed in net exchange position to control the exchange rate risk. Any question?
Sir, this daylight limit can be varied from one dealer to another, no?
Yes. Daylight limit and the overnight limit also from one dealer to another, and there will be a limit structure. What is the limit for the whole bank? What is the limit for the dealing room? Within that, what is the limit for a trader, different traders? Likewise, for a particular desk, then a dealer in that limit. There can be a structure.
So if one dealer has a low limit, then if he was asked to higher amount, then another dealer has to do that transaction.
Sorry?
If a person who is having lesser limit is in the daylight limit, then he can't do above that limit transaction. No? He has to
Yes.
hand over to another one.
Yes. He has to get the approval from the high authority. Or a limit or a trader who is having limit should do the transaction. Anything else? This article you can get it from the internet. Just do a search, and though it's slightly old, I think it explains you the basic concepts of interest rate risk, that what we discussed net interest income margin and things. Would be a good reading if anyone interest. Principles for the Management of Interest Rate Risk, Basel Committee on Bank Supervision. So we'll move to the next slide. This is not the exchange rate risk. This is the counterparty risk we face when we do foreign exchange transaction. So since this is mostly related to foreign exchange transaction, I decided to discuss here, but next week probably we'll have a separate session on counterparty or the credit risk. This is part of a credit risk, but I'll explain it here. What is a counterparty risk? For that, I don't know, I'm not sure whether I have explained it. Say two banks in Sri Lanka, Bank A and Bank B. Enters into a transaction, one party by USD, Bank A buy USD, Bank B sell USD. You know this. You enter into the transaction today. When do you settle the transaction? If you enter into the transaction today, when do you settle the transaction?
T plus 2.
Sorry,
T plus 2.
T plus
2.
2. That means after 2 business days or on the second business day. So assuming basically it's, if it is a spot transaction, this is the first day, this is the second day. Okay, you are supposed to exchange dollars and the equivalent amount of rupees on this date. Okay, now assume we enter into this transaction, Bank A and Bank B entered into this transaction at time 0, and now it now we have moved on to the settlement date. Bank A has to pay rupees to Bank B, correct? Bank A has to pay LKR to Bank B. Say 200 million. Assume 1 million is bought at 200. Then the Bank A pays 200 million LKR to Bank B. When do you do that? On this date. Say assume 2 p.m. Sri Lankan time. How do you make this payment?
RTGS.
Sorry?
RTGS.
Through RTGS. Through RTGS. Real-time gross settlement system in Sri Lanka. So Bank A maintains a rupee account with the central bank. Bank B maintains a rupee account with the central bank. Bank A instructs the central bank or these RTGS to debit its account and credit Bank B's account. So there for different type of transactions, there are different cut-off time that you have to settle these transactions. Before that, assume I'm not sure for a FX transaction what is the cutoff. So assume it's 2 p.m. in Sri Lanka. So Bank A pays 200 million rupees to Bank B. That's done. But how does the Bank B pay $1 million to Bank A?
Using your Nostro account.
You have to use a Nostro account. Where do you have that Nostro account?
If it's a dollar USA.
Yeah, since this is a dollar transaction, you maintain, or the Bank A maintains a Nostro account in US. Even the Bank B maintain Nostro account in US. And bank A may maintain a nostro account with one bank, and the nostro account of bank B may be in with another bank. Say one is with Citibank New York, other one may be with JP Morgan New York. That is also there. However, so when the bank A B receives rupees at 2 p.m. in Sri Lankan time, what is the time in US?
It is early morning.
Early morning, or maybe the midnight of the previous day. What is the
Or 12,
it's about
12
10
hours.
to, not exactly 10 to 12 hours. Yes. If it is 12 hours, 2 a.m. If it is 10 hours, it's 4 a.m. Somewhere in between that, depending on their time adjustments. However, they have not even come to office. So you won't settle the dollar leg. You have to wait until New York opens and come to that. What they also have some settlement cycles. Only on that time you will get your money. But in between that, whenever bank B transfers money to bank A nostro account through their respective nostro agents, in between that, for whatever reason, the bank B can bankrupt or no longer exist or ceased its operation. That can happen. Then what would happen? Bank A has already paid this rupee amount, but has not received the dollar amount. Completely lost. The full amount of the principal is lost. That is called this settlement risk. This is called this settlement risk. So in the foreign exchange market, this can happen because you do trade not only with the local banks, you do trade with foreign banks as well. So if you want to do a dollar yen transaction, you may do with the Singapore party. You sell yen and buy dollars. So in the morning, maybe around 9:30 in Sri Lankan time, by that time you have to settle your yen amount. So early morning you settle you pay your yen amount, but you may not receive it until midnight in Sri Lankan time, the dollar amount in US. In between that, it's almost sort of a 24 hours. Your counterparty may go bankrupt. You may not receive your payment or your dues. So that is the settlement risk. This came into surface or identified with the very specific incident happened in Germany. There was a bank called Herstatt Bank. That's why it's called Herstatt risk as well. It's a German bank. They had a lot of at that time. This is I think 1976. At that time they had Deutschmark as the currency. They had a lot of transaction, Deutschmark and dollars transaction with many international banks. But on a particular day, after German closes, the German regulator ceased or suspend the license, ceased operation of State Bank, and inform all other parties to cease any sort of payments. So by that time, most of its counterparties has paid Deutsche Mark into a state bank, but they have not received a cent in US dollars. So that created a lot systemic issue, because many banks are waiting for dollars to pay their other obligations, but the settlement fails because of this cease of operations, season of operations. So New York and the Fed and the other central bank has to intervene and provide some cushions to other banks to settle their or make their settlement properly. Otherwise, it could have been a systemic issue. So with that incident only, the banking community realized this settlement risk is there. That is only on the settlement date.
Sir,
Yes.
in case of the, even though that we are settling on the date T2,
Mhm.
we have already instructed our Nostro Bank to do the transfer. Don't they do that?
Yes. Within that 2 days, you instruct, but they don't execute that unless the value date comes and the proper timing comes. But this what happened? Soon the regulator asks you to cease. You cannot transfer any cent. That's true. You have received instructions 2 days or 1 day prior to the settlement date, but still you cannot transfer any money beyond that. So whenever you get a court order, even in domestic market against one party to seize all its asset, even though you have come to an agreement the day before or months ago with another party, you can't transfer the assets. No,
If
everything
they
will be
don't know,
seized.
if the instructor receiving party don't know, that can happen. But if this is something real, that can happen. No?
Sorry.
This is something risk that really can happen. No? Not
Yes,
very
in a way,
frequently.
very rarely, but not. Sometimes it may not be rare, because you never know. Okay, this is this incident. Is incident very rarely happen. How do you know whether they have adequate nostro balances in their nostro account? If they don't have nostro balance, if they have not instructed the bank properly, the bank B has to give proper instructions to its nostro agent to make the payment.
So if they
have not done it, still this can happen. You won't receive your fund on time.
if they do not have sufficient funds in nostro account, that means that is credit risk, not settlement risk.
No, it's a settlement risk part of, because on the settlement date you don't get the fund. That's why the settlement risk is part of the credit risk. On that date you don't get your funds. The transaction would not settle as you wish. This is that's why the settlement risk is part of the credit risk. That's true. Whenever you say credit risk, it is the inability of the party to pay it. It can happen in the settlement risk, or it can be pre-settlement risk, things like that.
So
That's
another
why
thing is
it says counterparty risk, the risk of your party, other party. It's basically the credit. Yes.
the other thing is the German central bank or something like that. They immediately cancel that.
Yes,
What
because
is the reason?
generally that's how the regulator acts now. On a holiday or after the market close. Otherwise, there will be a lot of panic. Generally, they do it. They announce things like this after the business is closed, or that or over a weekend.
They're doing that they are asking for other banks also to run that is putting a risk on other banks also doing that type of action, taking such type of action.
Yes, it can happen, but otherwise the repercussions would be much bigger. If you announce during the market hours, everybody will get panic, and even people will come and try to withdraw from the banks which are running good. So you have to think about all those things to avoid that panic. That's how normally react.
Usually, sir, cancel a license. That should be a very huge. There may be the reason may be very huge, no?
Yes, that's true. Why do they cancel the license? That's a different story. There should be a proper explanation for that. That's true. That's a different story. But if that happens, what would happen? That's what we are discussing. Why do they cancel the license or seize the bank? That's a different thing. Even if you can remember what happened in Sri Lanka when there was a problem with Ceylon Bank. When does the central bank announces that takeover and the shifting or transition of the management? You don't do that during market hours. Then people have access to system, they can transfer assets to anywhere, all those things. Everything has to be considered.
So, I mean, sir, without cancelling that, they could have gone for another action rather than that one. Then it depended on the nature
Sorry?
of it. Rather than cancelling that license, they could have taken a note like in Sri Lanka, what happened. They could have
So
done
that depends on the market and practice and the reason behind that. We can't argue that. That may be the best option that they had at that time. We don't know why that. Just read the stat store. It's not just a immediate action that they take. They had the study.
Okay, sir. Thank you.
That's why aftermath they took some remedial actions to calm down the market and for the smooth settlement of other transactions. They help other parties to carry on their business. Otherwise, it would be a systemic risk, and the whole system will collapse. With those only the people even the regulators learn things, so they arrange other mechanisms, things like that. As you said, without cancelling license, whether we can change the management or whatever it is, that depends. So that's about resolutions, how to do that, wind up a financial history, what are the ways available and what is the best. That's a different story. If that happens, this is the result. And in this case, what we discussed on the value date, if the counterparty fails to make the payment, that's the settlement risk. But say during this day period, once you enter into the transaction, but before you make the settlement, so even in this Herstat case, there could have been transaction took place on this T plus or this date. The German regulator sees the operation of Herstat on this date, T plus 1. Then what would happen for these parties? They have not made any payment. They can cancel their transfers. Not only that, nobody will accept that because now the Herstat bank is no longer there. Is there any risk to these parties? Those who have entered into a transaction with Herstat to be settled on the next day, but not yet settled. Is there any risk? Yes. Now you know for sure your transaction is not effective. You won't get that money. But you did that transaction, you entered into that transaction with some purpose because you need that cash, that fund or that currency. That's why. Now what do? You have to enter into a transaction with another party on, say, earlier you did it on the spot date or spot basis. Now one day is gone. Now on term basis, maybe on cash basis. But with the failure of one bank, market might have gone wild, maybe volatile, highly volatile. Exchange rate might have moved in one direction. It may be in your favor or it may be against you. So you face that risk still. Though you don't lose your principal amount, there's a cost of replacing your transaction. You have to go through another, again, maybe a broker, pay the brokerage and the rate difference. That risk is called pre-settlement risk. You are sure that your transaction is not going to settle, so therefore you have to enter into a new transaction, replace the previous transaction with a new one. There will be a cost on that. That is called pre-settlement risk. So therefore, when you select your counterparties with whom you are going to trade, you have to think about the credit quality of the other party. For that, basically, simply banks places settlement limit and the pre-settlement limit, or you do netting instead of settling the whole amount. There can be transaction in both ways. You, whatever you bought, whatever you sold, then you in the same currency pair, then you can net it and make a payment from one party to other party based on that net amount. So then the settlement risk would be minimized. You can do that as well. In the settlement limit, what do you establish for a particular party? What would be the maximum amount
Excuse me, sir.
that you are going to settle with a single party? Yes, go ahead.
Excuse me, sir. In the pre-settlement risk, it is risk is it's very minimal, no? Amount which we incur.
That depends on the market volatility. If the market is highly volatile because of a failure of a large bank, then maybe a gain or a loss. That is also there. But depending on your trading volume with that bank, so it can be huge or very low. However, that is something that you have to consider. You cannot ignore this risk. So therefore, in the settlement limit, you put a ceiling. You cannot settle more than this amount on a particular day with this bank on a particular day. So every day you cannot exceed this settlement limit. But in the pre-settlement limit, as you mentioned, the sometimes the bank considers only the mark-to-market gain no loss. That is the loss you may incur because you don't lose the principal. So therefore, considering the accumulative or the cumulative figure of all the transaction which are not settled yet, you calculate the pre-settlement limit, and that limit would be small if you consider or measure it as the mark-to-market gain. If you measure it again in the notional amount, whatever the transaction volume that you did, then it will be a much bigger than the settlement limit, because there can be outstanding transaction to be settled in two different or different days into the future. There can be forward transactions, spot transactions. So therefore, everything will be contributed to the pre-settlement exposure. If you measure it in notional amount, the limit should be high. But if you measure it as the mark-to-market gain, then the limit would be low. That has to be specified, whether you measure the pre-settlement limit on the notional amount basis or the mark-to-market basis. If you measure it through the mark-to-market basis, limit also would be low, but you have to be within that limit. And the netting and the continuous link settlement systems are also the risk mitigating measures. Netting is, as I mentioned, there can be a lot of buy and sell transactions with the same party in the same currency pair. You try to net. So whatever the payments due from you and due from them, you net it, and there should be one party should pay the difference to other party. So just make that payment. Then the settlement risk will be minimized. Not only that, there are a lot of advantages of netting. Your funding requirement is also low. If you do gross settlements, you need a lot of money turnover. But in netting, you don't have to maintain that much of money or funds in cash form. Then the other one is the continuous link settlement systems. It is a PVP mechanism. What does it mean by PVP? Payment versus payment. Not like in the previous case we discussed. One party pays its currency and wait until or wait for a few hours or almost a day until the other party make the payment. In the continuous link settlement system, both parties has to present their funds. Seeing that funds are available, then only they make the transfer of funds. So in this example, it's a bank in London and bank in Zurich. They do a dollar yen transaction. So the bank in London, they have a correspondent bank in Japan. Bank in Zurich also, they have a correspondent bank in Japan. They have a correspondent bank in US as well. So what would happen? London bank will instruct correspondent bank in Japan to pay JPY to the corresponding bank of Zurich bank in Japan. But there's another entity, CLS, in between these two. How do you settle that transaction? Bank A has to make available the yen amount to the bank, correspondent bank in Japan, and that bank will tell the CLS party, okay, the funds are available. Same thing from the bank B in Zurich. They have to make sure the funds are available in its bank account dollar. By seeing this dollar amount and the yen amount are available, then CLS will immediately transfer the ownership of dollars from from bank B's corresponding account to the bank A's corresponding account, simultaneously transferring funds from bank A's corresponding account to the bank B's corresponding account. But to do that, you have to maintain an account with CLS. Most probably, you have to park that funds one day in advance to make sure that the trade is settled smoothly. So then this will eliminate the settlement risk. If the yen balance is not available, the CLS agent will not transfer dollar amount. Or the dollar amount is not available, the CLS agent will not transfer the yen amount. Like in our DVP, foreign exchange, government bond settlement. So therefore, this will reduce the counterparty risk or the settlement risk. There are more mechanisms now available in the markets. Central counterparty, that means like an exchange for futures contract. One party comes into the middle and novate all the transaction with all the participant banks. Then each party takes the risk of only the central counterparty or the clearing house, not the bank or the other financial institutions in the other side of the transaction. That is also there nowadays. That's the emerging situation. There are a few central counterparty mechanisms around the world. So that's about this counterparty risk in the foreign exchange transaction, and I think that's enough on the foreign exchange side and from the risk management perspective. If you have any questions.
So slide number 2 and 3, please.
2 and 3.
Yeah. Please, sir.
This is 2. As I mentioned at that time, the counterparty risk and the settlement limits. This is not exactly the foreign exchange risk that is arising due to foreign exchange transactions, not because of the FX or the foreign exchange rate movements. But the whatever the loss that you incur, that depends on the exchange movement as well. In the third one, what is the net exchange position? The net exchange position is the difference between asset and liabilities in a particular currency.
Thank you, sir.
Okay.
Sir, to do the netting, sir, it should be in a same currency transaction. We can't do separate currency transaction.
Yes, you can't net different currencies.
Sir, for PVP mechanism, is there a separate system available?
Yes. There are CLS. You have to go through that. Then all parties has to be agreed that you to go through that and things like that.
Is it available for Sri Lankan banks also?
No.
No?
CLS not available in Sri Lanka, but we are going to move into a CCP, central counterparty.
That is, Mr. Shanta, for debt trading, no?
Sorry?
That is basically for
initially for government bonds.
Government bonds and bills, no?
But no, the scope is for the foreign exchange transactions as well.
Okay. When is it?
Not only foreign exchange, most of the transactions taken place in the domestic market. Foreign exchange, we have a small problem or the concern how are we going to settle the foreign exchange leg, foreign currency leg. So however, that is on the card.
The central counterparty for government securities, is it going to be rolled out in the near future, Mr. Shant?
I think it may take 2-3 years. I'm not sure what is the time target. However, the project is ongoing.
CCP only for Sri Lankan banks, domestic market only.
Sorry, I can't hear you.
Next week
CCP
will be based on the regulation and compliance module or any other something else.
Oh, sorry, my volume is. Sorry, can you repeat it? I think there were two questions. I didn't hear anything.
CCP available only for Sri Lankan banks, domestic market only, no?
No. What we are going to propose in Sri Lanka, it's for the, yes, within Sri Lanka. Or I don't know whether it's possible for us to ask foreign parties to participate.
So it is for that is
Sorry?
that is instead for RTGS system is something like that. That
Yes,
is
some not necessarily. We need the RTGS as well. It will be a combination of RTGS and yes.
okay. So then
So next week will be based on the regulation and
No.
compliance only, or something any other?
Next week also, I will discuss it on credit risk.
Okay.
Then indeed I couldn't check with Sarjan whether he's available. If he's available, then yes, we'll start with regulatory session. Maybe again for another 2-3 weeks. And I'll give you the assignment next week. So I'm going to discuss the credit risk next week, and that the CCP thing. Okay, I'll let you know now. That is something going to happen in Sri Lanka. So the assignment will be on that. I'll give you the proper assignment next week. So the assignment will be on CCP, Central Counterparty. So you can start collecting information about or read about central counterparty mechanism and the structure, advantages, disadvantages, why do we need that, things like that. Anything else?
so in case of forward transaction, the settlement risk is higher, no, than other.
Yes, not the settle. Yes, in a way, settlement risk is high because it's more into the future. You don't know, say, if it is a 1 month forward, you don't know whether this bank will be there after 1 month period. So, but not pre-settlement risk is the, I think, the high, because even before you reach the settlement date, the bank may not be there. But if you know today the bank is there, tomorrow is the settlement date, then the risk is almost same. So the pre-settlement risk is high.
Okay, sir. Thank you.
Anything else?
Assignment will be on next week, no sir?
Yeah, I'll give it next week. Yes.